Hello and welcome to Sound Financial Bites. I'm Paul Adams, President and CEO of Sound Financial Group and your host of today's podcast. We've got a fun topic today. The topic is why I don't want to buy your business. But the person that doesn't want to buy your business is not me, Paul Adams, but our guest today, Paul Menig. What I want all of you to think about is what you can do to increase the value of your business as you listen today, or what you can do to have your business increase what it puts on your personal balance sheet. I'm going to talk more about that throughout today's conversation with Paul Menig. But if you're a business owner, those are all crucial topics. If you're an executive for a business right now, each one of these topics are going to be equally relevant in the points that Paul Menig makes today, because there's an owner that you're working to satisfy somewhere in your role. So I know that what all of you are going to be able to do is take something valuable away from the conversation today. So let me tell you about Paul Menig, our guest today. Paul built his career, and some of the biggest marks he made on industry was as an executive helping accelerate technology inside Daimler North America and Freightliner, two large trucking companies that you might normally think about as being stuck in the past, and helping them adapt new technology. And as he's done that throughout the years, and then created his company that's called Tech-IM, Business Accelerants. Now, what he does is help business owners increase the value of their companies so that those companies are able to sell for a better multiple when they ultimately sell, and along the way, doing a better job of them being able to drive money to their own personal balance sheet. Now, we're going to take this conversation with Paul today a little bit different direction, because Paul's actually in the process right now of buying a company. And as he's done so, we're going to talk about the journey of doing that and why he doesn't want to buy these businesses and what you can learn from that journey. So, Paul, thank you and welcome to the show.
Paul, it's great to be here with you. I'm looking forward to helping people understand how they can get more money out of their business and more time for their life. Because as we talked about, wealth is more than just money. It's also the time and the relationships that you have. It's health that you have that allows you to enjoy life. You tie up so much of your life in your business, and you have to know where you're going to go afterwards with that. That is in terms of your time, your money, and your relationships, as we just talked about.
Yeah, and that seems equally valid, that our wealth, being more than money, is so crucial for both people who are business owners and some people who are just building a career as, an executive that's just killing it throughout their career. What are they doing to build the relationships outside? What are they doing to take care of their health outside of the routine of business, so that when they're done with their work, they're not done with their life and they're not done building wealth?
There's a lot that is very similar to what happens the way a business coach approaches asking you about your business, and a wealth management person asks you about your life. The first thing you do is ask, what do you want to do after life, after business life? Mm-hmm. What is it you want to do? You want to travel? Do you want to help charities? What is it you want to do? You begin a process of dreaming and creating a vision for that new life. If I walk into a business, the first thing I ask is, well, what's your vision? What's your mission? Where do you see this business being in 3 to 5 years? And then we'll make a plan to get us there. It's all about what that business owner or the leadership in that company wants it to be. And so you can't separate business and personal life entirely.
I think that's so key. And if we don't have that vision for beyond whatever we're going to do with the business or our career, it's a little bit in question about, for the sake of why are we doing anything? So, a big part of Paul's business and Business Accelerants and Tech-IM is this idea of being able to engage business owners to help them be more effective as a business owner, being able to recapture time and being able to capture the actual value of the business that they're building. But now you've been on this journey. You've actually sat with and or reviewed or met with business owners of how many total companies so far?
So far, I did a tally over last weekend. It was about 43, but we've added a couple since then. So it's on the order of 45 or 46 different companies, many of which we've already seen the financials on from a business broker or we've just had a chance to meet with the owners. This week alone, my son and I have spoken directly with business owners of 7 different companies that that are on our list of potential acquisitions. Some of them we've seen the financials. Sometimes the owner, even though they've signed an NDA with us, they don't want to give us the financials until they meet us and see if we are good people.
Yeah. Isn't it interesting, both how people go about that? They want to see the person before. But I think what our audience is going to find really interesting is, of that many, you said 2, 3 are real possibilities, given that you've seen the financials now.
Yeah, less than 10% of the 40-some companies that we've looked at would pass muster to meeting the kind of criteria that we're looking for. Some of the criteria is personal. My son and I have put together a list of about 9 different items. He's looking for flexibility in his work schedule because his wife also works. We're both looking for growth. We're looking for profits. We're looking for an industry that maybe makes a difference. And so there's those criteria. But then there's just the plain criteria of, is this a business that we can get the kind of salary and growth potential out of it that we want? Can we find a business that would support the necessary loan payments that we might have to have with that business? Mm-hmm. And it's amazing how few businesses muster up to where it's something that we can take over and it can be run without us having to maybe find a specialist. A typical example, whenever we look at a business, we look to see whether or not the owner of the business is the business. Because I'll devalue it immediately because I've looked at some businesses in the last 2 weeks alone where it's a PhD who is running the business, and he's very good in his area of expertise. And if I were to come in, I'd have to go hire a PhD in that particular discipline to do it. And so that means I have to pay him a salary. And so I don't get any money out of the business as a result.
So simply put, to bring some numbers, that might be something the effect that the business owner says, well, this business makes $200,000 a year. But in reality, the market for that PhD you need to hire is $150,000. So you'd be buying a business that only made you $50,000 a year.
That's right. We look, everybody on the buy side at least begins to look at the seller discretionary cash flow or the seller discretionary earnings and trying to understand what they're taking out of the business. That may include that they've got some family members in the business. And so the people we're working with, the financial broker type people, they'll all add that up and stuff. And they will say, well, my daughter is getting some money out of the business. That's $20,000 a year. So they add that to the seller's discretionary cash flow. But wait a minute, that daughter was doing something in the business. I have to replace that. So I personally, as the buyer, don't see that as belonging in the seller's discretionary cash flow. Another thing is I'm always looking at a business to see how much it can run on its own in terms of processes. Or is there some key employee in that business that if they leave, nobody knows how to do anything in that business?
Yes.
And that's, you were talking earlier, executives in any business, document your processes, every process that you have. I don't close my books for my own consulting company but once a month. Yeah. I don't remember everything, so I have a step-by-step process that by following it, I can check off that I did everything correctly. If a checklist is good enough for a surgeon to make sure he doesn't leave a sponge in somebody's body in a surgical room, it's good enough for me. If it's good enough for an airline pilot before he takes off with 300 people on a plane, it's good enough for me and what I'm doing. Checklists are the simplest way of documenting a process.
Yeah, and what you've probably seen the book. I think many of our listeners have read it.
Checklist Manifesto.
Yes,
excellent book.
Checklist Manifesto, great book, and so wonderful in the way that it can release cognitive load for us as individuals to simply have a checklist that we can refer to, and all the more so to document systems for a potential buyer. Now, you brought up when we were chatting before about this idea of how most buyers or sellers are trying to set the price for their business, and they're using the criteria of what they need.
Yes.
So could you talk a little bit about that?
So even outside of what I do with trying to buy a business right now, but when I'm talking with other people who are thinking of selling their business, one of the first questions is, well, how much do you need? And in one of your recent podcasts, you went through the classic, well, you need X amount of money and then draw only about 4% of that per year for the rest of your life. Because even at my age, I'm still looking at 20 to 25 years of life that I have to worry about. And if somebody is 55 and trying to sell their business, they've got even more years that they need to draw at that 4% only kind of rate.
Indeed.
So typical scenario comes up that these business owners have put all their wealth into that one basket, which a wealth planner would say don't do. You need to diversify where your wealth is put. They may not have a 401k. Everything is in that business. And so they're counting on that business having a lot of value. But then the buyer is not looking at what you need. The buyer is looking at what the business can support. I'm amazed. We often hear this 2x to 4x multiple on seller's discretionary cash.
Yes.
Coming from the corporate world, I find that extremely easy to understand.
Yes.
If I was trying to convince somebody at Daimler that we needed to put in a new piece of machinery in my engineering department that was going to cost $10 million, I then had to prove to the controller that I would save about $3 to $3.5 million per year so that would pay back in 2 years, roughly, to 2 to 3 years. I actually had to sit in a controller's office on a $10 million investment, and he literally wanted to take a razor and slit my wrist and say, Paul, will you commit that we're going to save this kind of money? Well, that's where the 2x to 4x comes from. I'm putting in cash, and I want some money back in a reasonable amount of time.
Well, and I think that's what people forget is that when we ultimately sell a business, we're going to put money on our balance sheet. And you got to have about 25 times to mimic the same amount of cash. That's the difference of human capital earning income versus capital at work earning an income. And when it's capital at work, if we want to replace 200,000, it's going to be about 5 million, which means we got to sell the business for a little bit north of 6 million to then pay the taxes to then have the 5 million to produce the same 200,000. For the business owner that wants to do that, they're not going to sell for a 25 to 32x multiple, except every now and then we'll see somebody do it in the entrepreneurial community. And of course, that story gets told and people beat on their chest and it's great. And unfortunately, too often, people aren't looking at all the normal sales that happen every day and that you're more likely going to be in that 2.5 to 6 times, seller's discretionary earnings for smaller companies or EBITDA for larger companies. But there is no pot of gold at the end of the rainbow unless you put it there.
I have been an angel investor, and I still have some investments out there, and I've studied the statistics behind it. There's a great professor at Willamette University who regularly reports on it in the Portland angel market. And you're going to be looking at needing an average of 20 different angel investments on a continuous basis to handle the fact that about 6 of them are going to completely fail and you're going to lose your money. 2 or 3 of them may return 1x to 2x on the money that you invest, and 1 might actually produce 7 to 10x on the money that you've returned after 7 years of investment.
Maybe.
Yeah.
Maybe. If you got the right 20, one of them might be sort of a unicorn.
Yes.
Yeah. But it's probably not going to be LinkedIn. It's probably not going to be PayPal. It's probably not going to be Facebook.
Yeah, and those are what I'm considering growth businesses as opposed to what I call a lifestyle business. And so if somebody wants to buy a grocery or a deli, or somebody is buying a gas station, or they're getting into the franchise business with a Menchie's yogurt store or something like that, these are not growth businesses that you can ever expect to sell for 10 and 30x earnings, let alone 10 to 20x sales, which happens in the software applications area. So your expectations of a business owner sometimes are skewed by what they're reading on the internet versus what's really when a person like myself was coming in to buy a business and is plunking down money and saying, well, I'm looking for a return better than 5% in a bank, but I'm not going to pay a huge premium for the privilege.
Yes. Oh, that's great. That's great. Yeah, I can't pay a big premium to have the privilege of owning your business. It still has to make financial sense. And we've often talked to people saying, in speaking to the entrepreneurs organization up here in the Seattle area, the idea that would you buy your business for as much as you're thinking you could sell it for? If you had a competitor selling for that amount, and most people go, oh no, I would only pay like 5 times their actual profit. Like, what do you think anybody's going to pay more than that for yours? Talk a little bit about what you've seen with business owners that have real estate affiliated with their businesses, and some of the, like, why do you not want to buy their businesses either?
Okay. So I've seen 2 different situations in the last couple of weeks as I've looked at things. The idea that there might be real estate involved in a transaction when I buy a business is something good from my perspective. Because when I try to leverage other people's money through getting a bank loan that's backed by the Small Business Administration, if there are assets like land and a building involved in it, I can depreciate that loan over 25 years versus the part of the loan that I'm using to buy the business, I can only depreciate over 7 years. So I have a much bigger payment. So I can buy your business when you have land or assets, and I can have a lower overall payment because part of it is a 7-year depreciation, part's a 25-year depreciation. But if the building is on your own property, now I don't have access to your property and you're not selling me the business. You've put up a business where I have to now have the cost and expense of moving the business. I now have to put into my purchase criteria that I'm going to have to pay rent as well as all that moving expense. And you've been giving the business the rent for free.
Yeah, the owner has allowed it to ride on somehow his personal balance sheet, and that's masking the lack of profitability in the company.
Yes.
Yeah. That's great.
The second thing that's happened is there have been a couple of occasions where I look at the business, and it is a true lifestyle business where the owner is working his butt off inside the business, and his family members. And that's it. They are the business. But they made a good decision a long time ago, and they bought the building. And right now, the building might be worth $1 to $2 million, and the business is worth about $200,000.
Yeah.
They'd be better off for their own personal wealth of just closing the business and selling the property, or finding a way to lease the property. But honestly, the one property I'm thinking of in my head, the building is inappropriate. They need to demolish the building and put up something else that would be tremendously more valuable in that particular area of town.
Yeah.
I don't know what they're doing in looking at their business and their personal financial wealth, that they're not seeing where the value is and how to get it out of a building or out of a business and onto, as you say, their personal wealth statement. Yeah.
If they don't get it their personal balance sheet, they're never going to retire on the business one. You mentioned something about this idea that somebody needs to engage. They need to engage a coach. They need to engage someone like yourself well before they get to the point they want to sell. Because people are at some point saying, I think I want to sell now or in the next 6 months. And then they engage a business broker or somebody else. And that's the first time they've probably had anybody, for many small business owners, first time they've ever had anybody else come and look at that business to offer them any thinking.
Yes.
Tell me about some of those where you're experiencing somebody's making a decision like right now and they got to sell it soon and they're up against it.
So first I'll use a disparaging term that comes, I think, from the southeast of the United States or something. It's called lipstick on a pig.
Yeah.
How do you make a business suddenly look good? So I've looked at a number of different businesses which give me 2 to 3 years of their financials as they're expected to, almost required to. And it's obvious where a business broker has come in and said, well, you better decrease your travel and entertainment expenses dramatically. You better get rid of these subscriptions for magazines that maybe you think are for the customers out in your waiting room, but you know in your heart that they're really for you because your customers don't read Hot Rod Magazine. You read Hot Rod Magazine. Those are all good things that you can do in a business in our country, which is great. And a coach will come in and he'll make some quick changes to help you put money to the bottom line very quickly, because that's what people are going to look at. One thing you could do, if you would think of it, is have a separate set of financials that is the seller's discretionary cash flow or earnings separate. And I don't know why QuickBooks doesn't give that to you automatically. It'd be great if they did. Maybe we should talk to them about offering a new feature. A coach is needed in every business. I in the wealth management area, I know a little bit about stocks. My father-in-law tried to give me a book about how stock prices were. I think it was $1,000 in 1933 in the Dow, and then it was 3,000 in the 60s, and yesterday it was 18.6. So we're doing really great with everything. But I need a coach to understand all the different ways of investing my money and doing things. When I was in school, I played competitive tennis and squash. So I had this overweight guy that maybe he was real good when he was younger, but he couldn't play worth beans.
Yeah.
But he was a good coach, and he would be complaining to me that I wasn't putting out my best when I was out on the tennis court, and I would argue back with him that I'm doing my absolute best. Right? He was right.
Yeah. He would get more out of you.
It took me a long time to realize that. So everybody needs coaches in a lot of different places, and business is one of those. You can't know everything. And certainly you become blind to your own stuff, and having somebody else take a critical look at what you're doing and how it's being observed by somebody else is a great way of getting things done.
Indeed. And something that can change the value of somebody's business might be their own lease. Talk about that a little bit and what changes when somebody wants to change ownership of a company and get somebody new coming in.
So I'm helping one client right now who is buying an existing franchise. They're literally going to sell their home in another state and move to another state to buy this franchise. And of course, this franchise has a lease. Well, the first questions that come up are, well, how long is that lease for? Does that lease continue after the new person buys it? Can it be sublet, or is it the same terms? If you've got some businesses have had a lease maybe for 10 years, and in that 10 years, the building actually got sold to somebody else. Okay, but the new buyer of the building had to honor the lease. Now, guess what's going to happen when I come into that with a new business and change the hands of the company that's running that lease? I expect they're going to change the lease to something that is a more reasonable value.
So as a part of that due diligence package, you need to read the lease of the company that you're acquiring, because it may give them the ability to simply say, if ownership in your company changes, we get to renegotiate our lease.
Correct.
Yeah.
So in the situation we talked about where maybe I have to move a business as well, or the owner is not charging the business the full value of a lease. So I'll frequently tell people, number one, go talk to a commercial real estate agent and find out what the going rate is for square footage in this particular area. Then we'll figure out, because that's what I'm going to look at when I buy the business, is what is the going rate that I might have to pay for a new lease on property. And for the personal wealth issue of trying to get it onto your personal wealth, you're undercutting yourself if you're charging only $2,000 a month in rent and it's worth $6,000.
Yeah, absolutely. And not telling the truth about the weight that business really needs to carry, and make you more rigorous in the way that you manage the business's finances. I think that's crucial.
You're fooling yourself to think that that's what is the seller's discretionary cash flow and the profits in the business, and that you're going to take some multiple of that. Because when I do the thorough due diligence examination of it, it's not going to hold up to examination.
That's great. That's great. Now, You and I talked a little bit about this hierarchy. And I think this will be a good place to land us today and leave people with, is the hierarchy of how you kind of work through thinking about a career or earnings, and the idea that you can go work for somebody else. And I'll let you expand on these. You can go work for somebody else, or you can buy a business and own a job, or you can be a manager and executive in that company. Lastly, you could actually fully own the company and not have to go in, kind of the four different tiers, and how each of those appear differently to a buyer.
So I spent most of my career, honestly, as an employee in the corporate America. And I thought that was the best way to create wealth and, have fun, create friendships and all of that. I wouldn't recommend it, honestly, now to somebody else coming out of college. I'd recommend they go into the ownership of a business. You can be an employee of a business and you will make friends and relationships with the people that you work with. You will have the opportunity probably to go home at a reasonable hour at the end of a day in terms of time, unless something special is happening with that activity. You get some benefits, and so you're an employee of the business. You might be another level called a quote-unquote an independent contractor. But the laws and the regulations and the lawsuits that are going on are decreasing the number of opportunities of being an independent contractor. And you might fool yourself as an independent contractor to thinking that you own a business because you're a sole proprietorship. In actuality, you're just an employee in most cases, and that's why we have all these laws and lawsuits for co-employment. So you take the next step. It's the American dream. It's actually, I think, in our DNA as individuals to move out and to do something on our own and start our own business. But you may actually just be buying a job. It might start, say, as a hobby, and then some friends and family buy what you've done, and then maybe you go to a farmer's market, and then maybe you do some things online, and you get real excited because you sold $300 at the farmer's market, and not realizing that it cost you $600 to go there that day.
Yeah.
And you didn't, and that was before you paid yourself anything. So you end up many times when you own a small business and get started of just having bought a job.
Yeah.
It's really not a business. You are the business. And if you get sick, there's no money coming in. Nothing's happening in that.
Well, the other way that one I see happening, there's the hobby route that people end up owning a job. And then there's, as Michael Gerber calls it, the entrepreneurial fit we throw. We get mad at our employer one day and forget this. I'm going to go do my own thing. And we throw a fit and we open a business and now we own a job.
Yes.
Yeah.
The next step would be to reach the point where you kind of are president of your business, where you're the manager of a business. And so now you have somebody who actually does the production work. You are not the sole person that's doing the sales and marketing for that company, but maybe you're still dealing with the big accounts and things. Mm-hmm. So you've got a little bit more freedom in time to do with it, but you're probably still getting to office before everybody in the business and probably leaving the office after everybody in the business and doing work on your iPhone or your Samsung Galaxy phone or whatever it is. And the other employees are not doing that. And we put up on our thought process here that can you take a vacation from your business? Because your employees can. And you're still too much, as Michael Gerber said, working in the business rather than working on the business. But being a manager is a good step. The ultimate is to be a leader of the business, to where you've got friends not only in your own business, but in similar businesses around the country, maybe through a trade association, where you're a pillar of the community and they're looking to you for leadership as well as your wealth in your money to help with the charitable things that are going on. You've now got the time to take a week off, 2 weeks off, maybe even a month and take a trip to Europe or around the world kind of thing. That's what you want to go to. You want to go from being an employee or an independent contractor to owning a job, to managing a business, to actually leading a business. Then you've got real wealth.
Well, and the other thing I think about is not that you have more wealth, but each one of those becomes exponentially more valuable to a buyer. You mentioned earlier, it's like if you're managing and leading your business, kind of that second to last tier, as a buyer, you can learn how to do that stuff they're doing. But if they're the technician, if they're the PhD, then it may be a business that can only be sold to somebody else who wants to own a job. So it totally limits the buyer's market of who you're going to sell the business to. You can only sell it to somebody else that wants to own a job like you've owned a job.
Right. If you're a leader of the business, now I can look at that as, in a sense, I take that back. If I'm investing in a mutual fund or a mutual fund of mutual funds or whatever it is, I am basically investing in a company that is managed and run without my being in part of it.
Yes.
Well, when I buy a business, wouldn't that be great in terms of the value that it creates? That's why stocks and stuff are worth 9 times earnings or 12 times earnings and some of the things that they're doing right now. Think of that as a multiple. That's a whole lot better multiple than the 2 to 4x if you're the technician in the business.
That's great. That's great. And so the biggest takeaway that I'm hearing today is our listeners, if you're a business owner or if you're a key executive in a business and you're noticing that there's nobody coming in from the outside to have these conversations, find somebody. You can definitely get a hold of Paul Menig. Paul, can you give them web address, email, and we'll also have it in the show notes. So if you're driving right now, you can get it later.
Sure. The website is www.tech-i-m.com. But fortunately, with the rebranding, you can also go to businessaccelerants.com, and it will redirect you to that website.
Very good. And there's some great stuff to read on the website, too, about these 7 different business accelerants. Can't encourage you guys enough to get in there and get a chance to take a look at it. Paul, I thank you for your time today. This has been a great episode, and I think we're going to end up with a lot of comments. Don't hesitate to shoot us a note and let us know what you'd want to hear on the show in the future. Or if you have any specific questions for Paul for a future podcast, we'll have him back. Have a great day. It's great having you all on the show today.
Thanks, Paul.